Hello, everybody. This is Jason Wink, and today is Wednesday. It's just about noon, so there's about 4 hours yet before the markets close. And in this update, I just want to cover some of the recent action. I am back from vacation, had a wonderful time in Key West, Florida, for those who are wondering where I was. And so while I was gone, maybe I should go away more often. The stock market kind of turned on a dime and started a rally starting on October 3rd. The low intraday anyway for the year on the S&P was about 1,080, and from that low, the lowest point in a given day, the S&P 500 has rallied about 130 points. So it'd be about a 12.5% rally or in that neighborhood. What we're looking at right now on this particular chart is a daily chart of the S&P 500, and what it's showing here, among other things, is the last few weeks. So you can kind of see how there's a big drop that started at the end of July. From that point, the market's really just traded sideways. It's went through a period of drops that have sometimes lasted 2 to 3 weeks, and then follow that by gains over the course of a week or two, and then losses, and so on and so forth. And right now we're in the middle of one of those phases where the market is rallying up. And I drew a couple of lines, usually black lines that you see here, and one that kind of runs along the top part of the range, and another that's been along the bottom part of the range. And what's happened in the last week has really been interesting. For those who study patterns and technical analysis, which is probably not a whole lot of my readers, but in any event, what this is what's called a wedge pattern. And the wedge is simply when you have the top line kind of angling downward and the bottom line here angling upward. And so everything seemed to be trading within that range. And every time the market would hit the top, it would bounce off it and go down, and then it would hit the bottom of the wedge, it would bounce and go up. And the range was getting smaller. Now, the reason this is usually important is that oftentimes when the wedge is broken, it creates either further downside to the market or further upside. And right at the tail end of October, the market went through the bottom part of this wedge, and that's what drove it all the way down to 1,080 on an intraday basis. From that point, though, instead of staying below the wedge, it kind of worked its way back up, right back into that zone. It kind of stalled out yesterday near the top part of this. But then today there was some news out of Europe, and I have an article I'll pop up in a second. And that's inspired a little confidence. It's caused the market to rally a bit today. I think it's up around 1% as I record this. And so it's kind of broken through this top. Before I get too excited, though, about this, we did see the same thing happen to the bottom part of the wedge just a little over a week ago. And the market stayed below that and then popped right back in. So the sort of indecisiveness of the market is getting a little bit frustrating, though I suppose any gains are positive at this point. Another thing that I fear is that the market has really struggled around 1,220, so 1,220 levels where it's been stalling, really across the board the last 3 months, and right now it's at 1,212. So if it can break through that with some decisiveness and then move above 1,250, which was kind of the beginning here of this sort of stall, which also occurred back in June, then I would be shocked, honestly, if the market didn't move higher to the end of the year, maybe as high as 1,400 or thereabouts. So that would be the optimist view. The pessimist view would be if it doesn't make it through those critical levels, it'll likely go all the way back down to 1,100 or so. So it's at this point, I hate to use this term, but it's kind of a gamble to be invested heavily, because while there is upside, we're an awful lot closer to the top end of the range, the recent range that is. And so the smarter play, if you will, would be to be fairly defensive and wait to see if the market breaks through 1,250. And if it does that, as I said, if it goes up to 1,400, that leaves 150 points, or 10 to 12% of further upside. So being conservative right now won't hurt anybody, and if the market does continue to rally, and if there's some definitive news out of Europe that there's going to be a financial facility created to handle some of their debts, then there's again plenty of upside to be realized. If for some reason though the market stalls and goes down, being defensive again will not hurt you one bit. And I think that truly the odds are probably 50-50 that either of these scenarios will play out. And when the odds are 50-50, it's like a coin toss, so it's really a gamble to just be blindly aggressive at this point. Another little interesting thing I added to this chart is this bottom part here. And this is what's called a rate of change. And the rate of change is measuring 4 days in this example. To give some clarity to what that means, right now that number is 4.06. So what that means is that over the last 4 days, the market is up 4.06%. And when we see it go down, like it was here at the beginning of October, it was at about -6, which means I think this would be October 1st or 2nd, the prior 4 days were a 6% loss. And this is just kind of illustrating this range that we've been in since August, where the market will go for a few days where it's down 8 to 10%, like it was here. And then it will go over a few days where it's up 5 or 6%, and then over 4 days down 5%, then over 4 days up 6%. You can kind of see that just looking at these very short-term changes, the market's just whipsawing back and forth, where it'll have a few days where it's up 5 or 6%, and then follow those with a 4-day period of a loss of 5 or 6%. Right now we're at the top end again, as I said, of that range that it's been trading in for really the last 3 months. So a very indecisive market, one that hasn't been able to figure out its longer-term direction. A lot remains to be seen as to what will happen. As far as why things are happening like this recently, I have just a couple of articles I thought I'd show. Let's see if I can find the first one here. All right, so this is one here. This is from the International Business Times. I just thought it was interesting because this is kind of just saying, hey, what's happening today? The markets are up a bit so far this morning, and it's saying the reason is that the European Commission President, Jose Manuel Barroso, had a news conference this morning, and he essentially said that confidence can be restored through an immediate deployment of all the elements needed to solve the crisis. Only in this way will we be able to convince our citizens, our global partners in the markets, that we have the solutions that measure up to the challenges all economies are facing. So it's kind of interesting, you get some news like this that comes out and people are going, oh, this is great. There's some conviction that there'll be a plan, but there really hasn't actually been a plan. And really the main opposition to a plan in Europe is Slovakia, which is a rather small country. In fact, I think it's one of the smallest in the European Union. And their argument is simply, why would we want to, we're a rather poor country, why would we want to participate in a bailout fund that will bail out much larger, wealthier nations that just haven't managed their finances well? So that's their argument in any event. One thing I found really fascinating when looking at this was another article that was linked to this, and it's actually this one right here. There's an article linked to it that's you can see the title of it. It says, U.S. stocks are cheap. This rally will last, says analysts. Then when you read through this, it has a couple of people who then say that they'll, and sorry, I don't know why this page keeps reloading, but an analyst was saying, hey, I think, and this was, shish, what is going on here? I guess they want us to donate to something. Here we go. Try to get back to that page. There we go. So he was saying the same number that I actually mentioned a few minutes ago, and this was not just really literally purely coincidence. It was a analyst saying, hey, I think the market could go to 1,400 by the end of the year because he thinks that there will be a bailout in Europe, and once that happens, the U.S. stock market's cheap and it's going to rally. But then just below that, we'll see if the page reloads on us again. They have another person who's saying, hey, look, and this is Douglas Ramsey, he's an officer at I guess it's called the Luthold Group, and he was on Bloomberg and said, hey, the European debt crisis and its impact on the global market is going to take the S&P down to 975 in a few weeks. Now, I only share that because that just is a great microcosm of the indecisiveness of the market. You have some people claiming the market will go up to 1,400, and others think it'll go down to 975. And you could literally probably poll 10 different analysts, and they're all going to have these differing views on what will happen. And the reason, of course, is because nobody knows exactly what will happen. One thing we do know for certain, though, is that the market is still in a technical bear market, which is when it drops 20% or more in a period of 2 months or greater. And there's been 29 bear markets in the last 100 years. The average bear market lasts 17 months, and the average decline is about 31%. So the environment we're in right now, that is, its peer group, if you will. However, right now we're only a month into it. So to me, it's fascinating. I don't think there's ever been a bear market out of the 29 that we've experienced in the last 100 years that's only lasted 1 or 2 months. Yet there's people who are taking the stance that this will all be over with and done with, and the market will rally and be, up, to 1,400, which would put it in positive territory nicely anyway for the year. It would be, frankly, a 15-16% rally from where it is now, and push the market to being up nearly double digits for the year. So they're kind of going in the face of conventional wisdom, which is that 29 other scenarios that are similar to the one we're in now, this one is different. And I've always been really cautious when someone uses it. This time it's different scenario. And that was the same argument people had about real estate in 2006 and 7. They said, oh, real estate will just keep going up. This time it's different. The demographics and interest rates, needs for real estate support prices going up perpetually. People said the same thing about the dot-com bubble that was created in the late 90s because they said this is different. We've got a whole new technology, a whole new industry being born. And so it's okay for companies' prices to be 40, 50, 60, or 100 times their earnings. Of course, every time someone says that this time is different, it ends up not being different. In fact, it ends up being the same as all the times before, and bubbles are created, and then they end up bursting. So right now we're not creating a bubble, but there is definitely, again, and by all measurements, and this isn't just my opinion, it's actual fact, that we are in a technical bear market, meaning we have exceeded the definition of what a bear market is. And so all we can do is we can look at that and say, well, when you're in a bear market, the smartest thing to do is to look at that history and just be prepared, which is being rather conservative. And that's okay. There have been some short bear markets, but there's also been some that have lasted multiple years. And I think until we're decisively out of that bear market, it does not make sense to be fully invested or very aggressive at all. And while there might be some people, like in the articles I just showed, that will disagree with that, those are actually the folks who are going against all of history. And I don't think that's a smart place to be. Again, you're gambling with odds that are not in your favor. So that's the update for today. The third quarter is officially over. We're into October now, and have about 2.5 months left in the year. The S&P 500 and virtually every other index are still negative for the year, though they are off their highs, or their lows, by almost 10%. So that's a positive in a lot of ways. I'll keep everybody posted on how this develops. Again, the levels that I'm watching. The first step would be we've got to stay, got to get to 1220 and stay above it. Once we do that, the market should, I would say, almost definitively get to at least 1250, which would be another 3 or 4% higher than where we are right now. And if it goes through that level and stays there for a week or two, I would be expecting the market to actually hit those really high levels of nearly 1400. So, but if we stall out here and it goes down, my expectation would be a repeat of what we've seen in the last 3 months, which is every time we have one of these rallies, this is again that rate of change measurement, we'll probably see a decline. And that decline, just like it has every other time in the last 3 months, will just wipe out the gains made over the prior few weeks. So again, that's what I'm looking for. I'll keep everybody posted. Thanks a lot for checking out this video update. Have a great rest of the week, and I will be in touch.